It's not often that fact and opinion are the same, but today they do. Fact and opinion are the same. Today we're going to tell you why Dave Ramsey is a moron.
Enjoy the episode.
Take care.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And today, like I told you, it's not often that fact and opinion are one and the same, but today we are here to show you that it is, and Dave Ramsey is not only wrong, he is very wrong, and we're going to show that to you guys. Anthony, ready to get started?
Well, yeah, I've been ready since yesterday, but I had a client meeting run longer, so we're doing this today, which actually I think worked out better because I spent some more time.
You came in fired up today.
Yeah, reading the article. So there's an article in Yahoo that had talked about Dave Ramsey's disdain for one financial product.
Yeah.
Any guesses what that is?
Yeah.
It's whole life. And then we actually watched the video or the clip from his radio show. And here's what I found out.
What did you find out?
I tell you, Dave Ramsey is my personal energy drink.
Oh, okay.
What I tell you, the next time I'm feeling down or is kind of get that 3 o'clock kind of slump, instead of grabbing like a Red Bull, I'm going to play some Dave Ramsey.
Yeah.
That guy gets my blood flowing. Dave Ramsey gives me wings.
Yeah.
Right. And look, not IBC isn't for everybody.
Yeah.
Whole life isn't for everybody. And if we have a difference of opinion, I totally respect it. If you're like, hey, this system is better, or this concept's better, or this product's better, it's a difference of opinion, right? I mean, it's kind of like, I know you think that The Notebook is like the best movie ever made, but that's your opinion. Not everybody will agree, but you have the ability to think the Notebook is the greatest movie ever made. But we're going to focus on facts, right? What we're going to do here today is list out some of the statements he made. And again, opinions are fine, but facts are facts.
Yeah.
And so I'm fired up.
Yeah, good. You should
fired up.
You should be. And guys, to be honest, people have their opinions on whole life insurance. That's great, right? And we can't go out there and argue with everybody. But some of this stuff, we read this article, and the information that he shares in here is so egregious and so wrong that we had to actually put a rebuttal out there. So, all right, let's get started. Guys, if you want to go out there and take a look at the article, we'll share a link in there, but it's called Dave Ramsey Shares the One Financial Product That Is Not Worth It. We've already told you he's talking about whole life insurance. Anthony, let's go and look at this first point that he makes in the article. The first point that comes up is why he thinks whole life is a bad deal. And the phrase that's in there says your cash value buildup for the first 3 years is zero. And let's pull up an illustration and let's show him that there's a nugget of truth to this, but that is not the entirety of it. There's a couple things that we're going to point out to you. You want to pull this thing up?
Yeah. So what we did here is we ran an illustration, more of your typical whole life policy, which I kind of call it your mama's whole life, right? I mean, this is when people are bad mouthing whole life, they're typically referring to the traditional design, but Dave's still wrong on that.
Yeah.
Right. So what we did is we did two designs. To keep things the same, we did a 40-year-old putting in $20,000 a year. And so what we're going to do here is your mama's whole life. Let me go ahead and share this. If you're listening to the podcast, this will also be on YouTube. So on YouTube, we will be sharing the screen, so you will be able to see what it is that we're talking about. So right here, you can see the first 2 years we're putting in 20,000, and end of year 2 we don't have any cash value. Zero. But in year 3, we have about 11,000.
Dave, you're wrong.
So, but here's what I found with Dave. There's like an ounce of truth with a pound of lies. I mean, there's always a little bit of truth in there. First 2 years, and really we're kind of nitpicking here, but the problem is he's wrong on almost every fact that it's hard for me not to point it out.
Yeah.
But but here's what I want you to take a look at. In a typical your mama whole life policy, we put in 20 grand, cash value year 1, 0. Okay. Death benefit, 1.3 million. Then what we did is we designed it more of a typical infinite banking design. And with this one, we have like a base premium, and we also have the paid up additions. To make this simple, we didn't add any term riders or anything onto it, but typically when we do design a policy, we may add some riders to kind of make it run more efficient. But in this example, we wanted to make this ideally as simple, as straightforward as possible. But here we're putting in 20 grand. We have cash value of 11 grand.
Mm-hmm.
I mean, so again, the way that infinite banking design is going to be very different. And I will say, just to be clear, Dave Ramsey's well aware of infinite banking.
Yeah.
In fact, towards the end of that clip, they even talked about infinite banking, and I think he called us dumb butts. Is that what he did?
He called you.
But you say anybody who does infinite banking is a dumb butt, or just something like that. I'm gonna say I've been called a dumb butt before, but the last time I think I was like 6 or 7 years old.
Yeah.
Right. But so the key thing here in this design, we have more cash value, but if you notice, we have less death benefit. The death benefit is about 600,000.
Mm-hmm.
So we've half the death benefit, but much more cash value.
Mm-hmm. Good points, Anthony. The second point that he makes is he says that after you finally do start earning interest on the money, he says it equals out to about 1.2% on average in the policy.
Wrong.
Yeah.
Again. Now, so let's go back. Let's do two things. So let's not look at IBC right now. Let's look at your mama's, where we're at. And so again, what we did is we ran it until age 70. So put a typical whole life, put in 20,000 a year for 30 years. By the time this example is 70, we're going to have about $1.1 million in there. When we ran that into a rate of return calculator, it wasn't 1.9%. It was actually 3.5%. Okay. And one thing we just keep in mind, this is tax-free. So when you're, first of all, I don't like comparing the rates of return because that's not really what we're doing this about.
Mm-hmm.
What we're trying to do is we're trying to create passive income, right? We're trying to use this to buy assets. So the rate of return here is not that important. What's important is how you use it. Sorry, I'm going to probably get off on a bunch of tangents, but sorry, Cam. So now in a whole life, I mean, more of the infinite banking design, we put in 20,000 a year at 70. We have 1.2 million. Okay, so what I think is interesting. So that relates to, I think it's 4.3.
Mm-hmm.
Okay, so that's more of a realistic number. I mean, which is twice as big as what Dave Ramsey had pointed out. While we are here, I just wanted to point out during the IBC, our design at age 70, we have more cash value by about 100,000.
Mm-hmm.
But you know what? We also have more death benefit. At 70, we have about 2 million. And then on your mama's whole life at age 70, we have 2 million. So the interesting thing here, I just like to point out that, you know, how we efficient the way that we design a whole life policy. We're going to start out with less death benefit, but when you need it most is when you're going to have it.
Good point. Good point. Awesome. Ramsey goes on and he has another point in this section where he's talking about when you can withdraw money from the policy. On his website, he discusses how you can withdraw money from your whole life policy cash value only when you get to what's defined as maturity age. And he says that age is higher than you think. Some insurance companies define this age differently, but most agree on it being 120 years old. Maturity age is an interesting point that he makes here. Maturity age is actually when the policy matures. There's two ways an insurance policy matures. One is by design. Insurance companies will either choose either 121 years old or 100 years old. And what actually ends up happening at those two ages, whatever one is chosen, is that your cash value meets your death benefit. If for some crazy reason you're able to live that long, the arrangement is over. The insurance company will actually write you a check and send it to you. The policy is no longer in place. So you do get everything that is in there in cash value. But I thought it was interesting that they talk about that. The maturity age. Yeah, I don't have anything yet. Sorry.
Well, and let's just explain. I might be thinking, wow, 120 years old, right? But that's just the way they're designing the product. And there's advantages of designing it that way. And the reason being is a dollar is going to buy more death benefit, if we're illustrating it, paying it to age 121 as opposed to age 100. So what that allows us to do is make a more efficient policy, because that actually raises the MEC line, which allow us to have more cash value. So that's why we're using these policies that have that maturity of age 121. But I think what he's talking about is you can't withdraw the money until then. Like the money's tied up.
Yeah.
Let's just take a look at what we are able to illustrate here. In this example, let's do in this example with the IBC policy. And I don't know if we have it on there, but you don't need to pay premiums forever. I don't know if we have that on the agenda to talk about, but what we wanted to illustrate, you don't have to pay until you're 121 or till you're 100 or 80. You can decide when you want to stop putting money in. And the only catch is we got to pay premiums for 7 years. But after that 7 years, we can turn off premiums, and it's called making it a reduce paid up. And in essence, what they're doing is we just tell the insurance company, hey, instead of making these premiums until we're 121, we're going to stop now. And what they're going to do, they're going to recalculate the death benefit because they're not getting those future premiums. But the interesting thing is cash value is still there and it's still growing. So you can see here, we're able to illustrate there's no premiums going in. And in fact, now we're actually taking some money out. And we can take it out as a withdrawal or a loan. And we can take it out as a withdrawal up to your basis, meaning you can take out whatever you put in income tax free, right? But anything over that, we can take out tax free as long as it's a loan. And at this point, these loans we're never planning on paying it back. Mm-hmm. Okay. Or let me rephrase it. We're going to wait till the death benefit matures. Then that death benefit is going to pay off that loan. So him saying that we can't access the money till you're 121 years old, again is wrong.
Flat out wrong.
Yeah.
The other point that he makes here, he says, what if you take money out before maturity age, right? Mm-hmm. Which is what you were referencing. But the way that this article is written, it says, if you surrender your policy, you'll get what's referred to as a surrender value of the account, which is a fraction of the total amount. That is a gross misrepresentation of whole life insurance. And in fact, I believe what they're alluding to is IULs. So if you've listened to us at any extent over the years, you know that we're not big fans of IULs. And in fact, surrender fees are one of the main reasons that we're not a big fan of it. So to be clear, guys, IULs have a surrender fee that's attached to them. And if you go into an IUL policy, Anthony's pulling it up right now. is you will see, right, the surrender fee schedule outlined for you. And typically it's going to cover the first 10 years. So that is something that is they're going to charge you in relation to your accumulated value, the cash value that you have in an IUL. If you walk away from that policy, that's the amount that they're going to keep. It could be higher than what you've accumulated, which means you walk away with nothing, right? If that is less than what you've accumulated, they're going to keep the amount that's shown on that schedule right there. And now what we've got here is we've got a whole life insurance policy. And again, this is on the contract. This is what's stated. This says surrender charges. And it says this life insurance policy has no surrender charges. When you walk away from a whole life insurance policy, the cash value that you see that's in there that's listed, that is what you get. They're going to cut you a check and they're going to send it to you. There are no surprises. There are no gotchas. There's no surrender fees on whole life insurance. And again, that's one of the big differences between whole life and IULs. If we're going to be nitpicky and you look at that surrender fee, these premiums are actually prorated over the course of a year. So if you were to pay an annual premium and then walk away 2 months later for whatever reason, the insurance company would actually pay you the premiums that have not been applied for that remaining 10 months. So you'd actually get over and above what you actually have listed as your cash value on a whole life policy. So the other thing that he writes in this is said another option is take out a loan against the policy, which obviously means you would have to pay back the amount that you take. And that is a quote. Anthony, when I read that, I was actually a little upset the way that is worded. Right. And number two on the wording. And then also it's wrote in a way that is very dismissive, in my opinion, as far as the loan provisions on an insurance policy. Man, there is absolutely an opportunity that lies with these loan provisions. And that is a lot of what we talk about on the podcast. That's a lot of the education that we go through. And they barely give it a half a sentence of acknowledgement in this article, which tells me they have very little, if no, understanding of the loan provisions on insurance policies. So guys, again, right, the loan provisions are a great opportunity that you certainly do not want to look on whole life insurance.
Well said, Cameron.
Yeah, thanks. Awesome. There's several other pieces in here that we could touch on, but for Anthony's blood pressure, I think that we will not today. Anthony,
well, I'm feeling good. So there's a couple.
We got 5 minutes.
Ooh, there's a couple things I do. Some of the things that he said that kind of really rubbed me the wrong way. He had talked about, and here I quoted him, whole life is an antiquated product from the 40s and 50s. Okay. I mean, like, whole life has been around. There's evidence of that in the 1600s.
Yeah.
Okay. I think it was in Scotland where they did one for a monastery. But a lot of these insurance companies, Penn Mutual is the one that we just looked at. It's 175 years old. I mean, so not from the 40s and 50s, or maybe he's talking about the 1800s. Okay. Maybe Dave needed to clarify that. It's from the 1850s. Mm-hmm. But really, whole life was even available before that. And, one of the things a point I like to make is, if a product is so bad, people would eventually realize, hey, this is bad. I'm not going to buy it anymore. Mm-hmm. Right. But this thing has been around for over 200 years. There's got to be something to it.
Yeah.
Right. And another thing he said that these insurance companies build large buildings in the skyline of every city. Okay. Let me ask you, if you're driving in your car right now, look around. If any of the names on the skyline, how many of them are mutual life insurance companies? And then how many of them are Wall Street and banks? And for what's interesting, the insurance companies we work with, I'm willing to bet most of you guys have never even heard of. Mm-mm. They don't advertise. I mean, so this is just flat out wrong. And, originally I used to say, hey, Dave, I agree with about 90% of what Dave says, but there's about 10% I don't. And what I realized, there is a 90-10, but I had it flipped. All right. I agree with 10%. 90% is, I could have rhymed by saying full of something, but what I do agree with him on is we need to live below our means. We need to be saving and investing for the future. But you know what financial guru or even non-guru doesn't agree with that? But to me, what of a concern is he's wrong, like wrong on a lot of these. It's not, I don't agree with his opinion. His facts are wrong. The facts are wrong on this. What else could they be wrong on? And I'm gonna just a couple more things. Okay. Another thing I realized, Dave has a scarcity mindset, right? If you're in a financial trouble, or his solution is, okay, let's deliver pizzas, right? And let's start eating ramen, right? But we compare this to Robert Kiyosaki. He has an abundant mindset. Hey, we need to make more money. We need to find a way to stop trading time for dollars and try to have our dollars make more dollars. And you know what else? Last thing.
What else?
We just did this on the podcast about the human factors. Dave Ramsey suffers from the arrival syndrome. He thinks he knows everything, and he's not open to learning new ideas. Okay, I'm done. I will get off on my one more thing. Okay. You know what he said? Buy term, invest a difference.
Yeah.
We did the math.
Yeah.
And what you should do is buy whole life and invest a cash value. And we did a podcast and a detailed video on that. We'll put that in the show notes. And all we're really saying, do your research, do your math, and find whatever system or product or whatever is going to help you achieve your goals. Maybe it's not IBC. IBC is not for everybody, but it can be a great tool to help secure your retirement, increase your returns, and lower your taxes.
Well said, Anthony. We've got plenty more to say. I'm sure we'll revisit this on Dave Ramsey. Maybe next time I'll get to speak.
Let's hope not.
Let's stick around.
Go make it a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.